So that's just a follow-up video in relation to my last one about the new Thai tax rules, and in particular addressing a question that I've been getting a lot, which is, you say that savings are not taxable when they're brought into Thailand, but how do we differentiate between savings and income? We've got multiple bank accounts, we've got loads of investments, how are you supposed to determine which one's which, essentially? Of course, that's a very good question, because the answer to this is going to be very important in determining your potential Thai tax liabilities. So I think to understand this, we need to start from the ground up and understand what is income versus savings principally, and then think about how does this relate to the potential application of tax law. So first off, income always comes first. I think this is the most important thing to establish. If you've got savings, then by definition that savings has come from somewhere at some stage. You could have had income in the form of wages, it could be selling a service, it could be selling a product, it could be dividends, it could be a gift, it could be inheritance. But ultimately, all savings have come from income at some stage in your life. And then, once you've made income, you might have to pay some taxes, you might have your expenses in your daily life, and then you might decide to put some aside just to save for future, and that's effectively your savings. So of course, when we think about savings, we first off have to establish that what is now savings was of course once income. And so there's not so much of a distinction between them, they're obviously highly linked, but this is the good starting point to kind of understand where we're going. So from a Thai perspective, how do I determine if I've got income and whether this income might be subject to Thai taxes? Well, if you're a Thai tax resident and you make what's known as assessable income, then this could potentially be charged as an income tax liability in Thailand. And so you got to look at the Thai tax code to see if your income type does fit the definition of assessable income. And this definition is generally not dissimilar to what you'll see in most countries. You see nothing unusual here. Employment income, you got anything from business income, it could be anything to do with interest, dividends, capital gains, anything of that nature could potentially be subject to Thai income taxes. So if you're making money of that nature, and specifically if you've never been taxed elsewhere on that money, then you've potentially got a tax liability that is going to emerge in Thailand as a result of that. Now, in contrast, and in response to people asking whether taking historic savings into Thailand, could be taxable in Thailand, well, shifting your money between your own accounts or even converting it into cash, this isn't generating any new income. It's merely changing the form or location of that already earned money. And so again, going back to the idea of savings, implicit in this idea is that you potentially even paid taxes on this income previously. It's post-tax income, and so it's just not something that you've really got to be concerned about. It's more, once you're a Thai tax resident and you start generating this, potentially chargeable Thai income, then that's when you might have an issue and something you've got to think about from a Thai tax perspective. But of course, there's going to be a lot of nuance here, because savings are not fixed as savings forever. Of course, you could put money aside, but if you park money in the bank account, you'll be generating interest, and so that interest again is potentially income. It's new money that's coming to you, and again, you've got to think about that when you bring that into Thailand. That could potentially be taxable. Similarly, you might reinvest into assets that maybe generate dividends, capital gains. Again, this all kind of brings back to the idea that it is, money is fungible, things can move around, and what was previously income can become savings. What is now savings could become income again, depending on how you use it. So it is important just to be careful about, don't assume that anything is fixed and will stay that forever. You just have to look at it case by case and try and really establish, was this income at one stage, has it become savings, or vice versa? And, try your best to kind of categorize that accordingly. But because of this complexity and nuance, I have seen a lot of people just asking, well, how can I prove it? Let's say worst case scenario, I assume this to be savings, I bring it in, and then suddenly I get asked questions by Thailand and they maybe disagree and they try and impose taxes on me. So yeah, I mean, this is an important question, and hopefully we're going to get some guidance on this, because at this point a lot of this can only really be speculation. I can maybe infer some parallels with what I've seen in other countries. We don't necessarily know how Thailand might implement this. However, I think what would be a good principle to keep in mind is, if you've paid tax on it in the past, particularly in another country, and specifically if you were non-resident of Thailand at the time, generally speaking that's going to be very helpful, because you're going to be able to show that your income was previously subject to tax, and therefore is clearly your savings. And I think this is an important phrase, subject to tax as opposed to actually being taxed, because not all income is actually taxed. It could have been subject to tax. You could have, let's say you're from the UK, you may have earned £10,000 in the UK, but the UK has a personal allowance of over 12,000, meaning that if you earn only 10k, you generally speaking don't pay any income taxes, but your income was still subject to tax. So it still was basically subject under the UK tax law. It was actually assessed, and it was just deemed that there was no tax on it. So maybe similarly, you might be in the US, you might earn 10k from a business, but perhaps you have 10k worth of deductibles. All of your kind of US deductibles might come off to effectively give you a zero tax bill as well. Again, that's proof that your income has been subject to tax. It doesn't necessarily mean that you've had to pay tax to show that this is your savings, but you may have to declare that, look, I've made this income in the past, I've declared it in my home country at the time I was tax resident there, and therefore I've got evidence that this is basically post-tax savings. So tax returns are a very common form of evidence to show, look, I've got savings here, I previously made them in this country, and now I'm bringing them into this other country. Tax returns can be very useful, but on top of that, anything else such as pay slips from an employer. You might have evidence of withholding tax on pension distributions, anything you might be able to get from your fund provider, anything of that nature. Basically good evidence to document that what was once income to you, is now savings to you, because it's gone through the kind of process of potentially subject to tax, potentially paid tax, and is now net of all of that. Now, I can't say for certain that Thailand will ask for evidence that your money was subject to tax elsewhere, but I have seen this happen in Singapore, Malaysia, the UAE, and Indonesia. So basically, people have been able to provide their prior tax returns from their home countries to evidence that they're bringing in effectively post-tax income, and that has been to the satisfaction of those local tax authorities. Eventually, Thailand will have their own policies, and you just never know how they implement it. But for now, taking those parallels, hopefully that'll be a useful kind of guide as to what has been acceptable in other places, and hopefully Thailand takes something from that as well. Another issue is just the whole fungibility of money. You might have a lot of savings, but potentially those savings you're using some of them, and you're also getting income, you're adding to them, and you're almost at a stage now where you're kind of lost. What was my savings, what was my income at one stage, what am I taking out of income, what am I taking out of savings? And again, this can be extremely confusing. I think practical guidance for now is, let's just say you're coming into Thailand, and in future we're trying to assess what savings did you bring into Thailand, and then what money have you earned since you've been in Thailand. Well, it's probably useful to take a snapshot at the time in which you maybe first enter Thailand, because then at least you can say, well, as of this date, I brought these savings into the country, and anything that I have in addition to that, let's say you brought in $20,000, you can probably safely assume that you can spend $20,000 in Thailand and justify, these were my previous savings. But anything above that, you're probably going to have to explain, well, this is income that I've generated whilst in Thailand, and you may have to start accounting that from a Thai income tax perspective. But that's just one kind of practical example. In some cases, there's going to be a lot more complexities to navigate. But this all pertains back to, you know, one of the key points here. We just don't have much guidance yet. I know a lot of big advisors and consultants have been requesting this, and hopefully we do get some further practical tips. There might be some simplification that we get guidance on, but yeah, for now, you know, we just have to understand, first of all, do our best to kind of distinguish between our own savings and our own income. Make sure we have good records to kind of establish, you know, did I pay tax somewhere at some point? You know, I think that's usually quite a good starting point. And then, you know, on top of that, let's just hope that in the future we do get some, you know, further clarification from the Thai tax authorities. So, you know, hopefully this was a useful clarification. It is an important thing to understand, and you know, it's going to be something that is going to be, you know, more important as the following year passes, and the kind of first batch of Thai tax returns are going to be submitted under this kind of new rule. So yeah, hopefully this can give you a good starting point. But if you've got any other comments or questions, just give me a shout in the comments below. Cheers.